It's rare for the U.S. Treasury to step into the Fed's lane and say, cut rates and cut big. That's what just happened. The Treasury Secretary is publicly urging the Federal Reserve to deliver a half-point reduction next meeting and to follow it with a series of additional cuts. Within hours, stocks blasted to fresh record highs while bond yields slid and futures priced in near certainty that easing is coming. Let's be clear about how unusual this is. The Fed is supposed to be independent, and Treasury officials almost never push a specific number in public. When they do, it's because economic pressures have hit a breaking point. The question you should be asking isn't, will they cut? It's, why are they willing to break the rulebook now? Here's the backdrop they're looking at. Inflation cooled for a second month, and revisions to the jobs data show a softer labor market than the headline narrative suggested. Growth is still positive, but not hot enough to justify restrictive policy for long. In plain English, the case for easier money finally has cover. The market reaction tells you the rest. The S&P and NASDAQ ripped to fresh highs, rate-sensitive sectors rallied, and high beta names exploded as real yields fell. Spreads tightened and the dollar slipped, signaling global investors think the U.S. is pivoting back toward accommodation. When liquidity expectations change this fast, everything reprices at once. But this isn't a normal cut cycle. Treasury isn't hinting, it's pressing. The call wasn't for a token 25 basis points. It was for a shock move and more to follow. That ups the stakes for the Fed, which now has to balance credibility on inflation with a risk of tightening into a slowdown. So what would a massive cut actually do? First, it would pull the front end of the curve down and likely steepen it if growth hopes revive. Second, it would reprice mortgages, autos, and corporate borrowing, loosening financial conditions in weeks, not months. Third, it would force a scramble in positioning as systematic funds and risk parity models chase the new trend. Winners and losers shift fast in the setup. Growth and duration-heavy tech looks like the first in line, followed by small caps and cyclicals if the soft landing story holds. Banks breathe a little easier if the curve steepens, though net interest margins still depend on deposit flight staying contained. Commodities are the wild card. If the dollar keeps sliding, energy and metals can catch a second wind. There's a geopolitical layer too. A Fed pivot lowers global funding stress and relieves pressure on dollar-pegged economies that have been importing tight policy. It also undercuts the attractiveness of holding cash in dollars, which is why you're seeing flows into risk assets worldwide. When the world's reserve currency eases, the ripple hits every coastline. Skeptics will say the Treasury is playing politics and the Fed will resist to defend its independence. Maybe the Fed hates being seen as anyone's instrument, but officials also hate overshooting into a downturn and then having to slash in a panic. If incoming data keeps drifting in the Treasury's direction, the path of least resistance is to move and call it data dependent. Let's talk mechanics, because this is where most commentary gets fuzzy. Rate cuts don't magically print money, they change the price of it. Lower front-end rates compress discount rates on future cash flows, which is why high-growth equities fly first. At the same time, cheaper money lowers the hurdle for investment, M&A, buybacks, and refinancing, all of which multiplies through earnings expectations. Bonds tell their own story. A decisive cut typically rallies the 2-year more than the 10-year, but as the market sniffs recovery, long yields can back up again. That's where you get the bull steepener that banks and cyclicals love. If inflation expectations stay anchored, that steepening is a green light rather than a red flag. Here's the part that will trip people up. Record highs don't mean too late. In easing cycles that begin before unemployment spikes, equities have historically made their biggest leg higher after the first cut, not before it. Why? Because the discount rate tailwind persists for quarters, while earnings catch up to the easier policy with a lag. That gap is where momentum lives now. The Treasury's message also resets the debate around money's future. We're watching legacy rails strain under transparency demands as cross-border settlement still crawls through days-long processes. Meanwhile, blockchain-based rails settle in seconds and keep an immutable public trail. It's not hard to see which model looks built for a world that moves at internet speed. Speed matters because speed changes behavior. If settlement takes 3 to 5 seconds on networks like XRP, you remove hours and days where games can be played in the shadows. Faster finality shrinks opportunities for spoofing, warehousing risk off balance sheet, or quietly adjusting terms after the fact. When the plumbing is fast and verifiable, the surface drama has less room to hide. Think about what easier policy plus faster rails does together. Lower rates lower the cost of capital, Instant settlement lowers the cost of trust. That combination accelerates capital formation and breaks bottlenecks that used to be normal. It also sets a higher standard for transparency that old systems simply can't meet. Of course, nothing moves in a straight line. A hotter-than-expected inflation print could slow the Fed down. A credit accident could flip the narrative from soft landing to protect the system. And if the cut underwhelms after all this anticipation, you'll get a classic buy the rumor, sell the news shakeout. But step back and you'll see the bigger arc Treasury leaning this hard tells you policymakers believe the economy can handle easier money without reigniting a fire. Markets sprinting to records tells you investors agree, or at least that they don't want to be underweight when the tide turns. Both signals point to a regime shift rather than a one-off headline. So where does this leave you? In a world where the cost of money is likely heading lower, while the speed of money is getting faster. In a world where liquidity cycles are measured in weeks, not quarters. And in a world where transparency isn't a press release, it's a feature of the rails. Here's the final takeaway. When the people who control fiscal levers publicly ask the people who control monetary levers to hit the gas, you're looking at a coordinated attempt to reset momentum. If the Fed follows through, it won't just lift markets, it will change the tempo of the entire system. The window to position opens before the announcement, not after it. If you want more fast, no-nonsense breakdowns that keep you ahead of the policy narrative and the money flow that drives, hit subscribe to Wealth Signal so you never miss the signal in the noise. The futures market is already voting on the size of the move. Odds for a half-point cut spiked after the Treasury marks, and pricing farther out implies more than one reduction by year-end. That's not a promise, but it is the baseline portfolio managers will trade against. Watch the balance sheet as well as the policy rate. Quantitative tightening has been draining liquidity at the margins, but a slower runoff or a targeted facility can amplify the effect of rate cuts without announcing new programs. The Fed won't call it stimulus, yet the plumbing would ease all the same. Crypto and gold sit at the intersection of liquidity and distrust. When real yields fall and the dollar softens, non-sovereign assets typically catch a bid. With tokenization and spot products now mainstream, access is easier and flows can accelerate in easing cycles. The window to position opens before the announcement, not after it. Subscribe to Wealth Signal now to get fast, no-nonsense playbooks the moment policy shifts, so you can act on the rate moves, liquidity turns, and flow signals before they become everyone else's headline.